Interest rates on some mortgages in Canada have gone up over 250%, and some Canadians are saying they are worried upon renewal time. What about those people who took variable interest rates and who are feeling the pain as we speak? Is there anything that can be done to help them out? The answer is yes. Mortgage bailouts are coming to Canada. However, before we begin, I'm Josh Safars, investor and realtor with the XP Realty Brokerage. It's so amazing. If you can help us out, hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you guys are looking to invest in real estate with great cash flow, great appreciation, under $100,000 starting in USD, then click the link below. Let's book a call and let's invest together in our partnership. And also too, if you are looking to purchase, sell, or know anyone who's looking to do so, we have access to real estate agents all over throughout the world. So feel free to reach out at any point if you need any help. All right, let's talk mortgages. Many people are feeling the pain right now given how much interest rates have gone up. And we're looking at some mortgages right now, if you're looking upon renewal, at about 6 to 7%, and people are feeling the pain as we're seeing a massive amount of increase in their monthly payment. If you are a variable mortgage holder, then right now you're definitely feeling the pain on your monthly payments. Also, if you have a variable mortgage with a fixed payment, guess what? Your lender or the institution you're looking at is probably reaching out to you because you probably haven't paid the full interest or the full principal and interest on your payment, given how much things have increased with the interest rates. And in order to not have things get any worse, you're either going to have to make a large lump payment or increase the monthly amount that you are currently paying so you don't have a massive amount of an increase during renewal time. And for a lot of people, it's not as easy as just throwing a massive amount of additional funds to be able to help with the situation. Given the high cost of living, the interest rates, and the current political state that we're in, it becomes very, very challenging and difficult for many, especially middle-class individuals, to go about sustaining their lifestyle, having to make any additional payments. Lo and behold, we do have some lenders and insurance providers that are able to help Canadians out for those who have a massive increase in payments and having a very difficult time in making those payments. News came out recently from Sagent, the number 2 insurance provider in the Canadian mortgage space, allowing institutions to go about helping the consumers more without having to go to the insurance in order to receive the funds to help out clients. And one of the interesting components that Sagent has actually mentioned is allowing mortgage holders to increase the amortization of their mortgage to decrease their payments and really help with their GDS. This is the update from Sagent's default management update, helping homeowners in the situation of the rising interest rates. Essentially, it's the guidelines for individuals who have a variable, fixed, or individuals who are looking upon renewal in the very short future and are having a difficult time upon renewal. Now, what they're saying is if individuals' debt servicing ratio is above 39%, they are allowed to increase their amortization of up to 15 years, essentially maximizing to about 40 years potentially amortization. This is done so in such a manner to keep those debt servicing ratios down below 39%. Essentially what this means is they're going to be able to look at the situation with the amortization increase and see if these homeowners with their incomes are still able to make these payments. And this is essentially up to 39% of their income going towards only their mortgage payment. Before we look at the criteria in order to qualify for this product, we're essentially going to look into how to calculate debt service ratio. So essentially what you want to do is you want to check out your mortgage payments, which includes your principal and your interest. You want to add heat, including your taxes. Now for homes, let's assume that heat is about $150 per month, and take that number and divide it by your gross annual income. And if the number you receive is 39% or higher, then you've got a really good chance of being able to qualify from the insurer. Now, in order to qualify for Sagent's guidelines, you're essentially going to have a variable or an adjustable rate mortgage. Now, variable rate mortgages as well as variable rate mortgages with a fixed payment will be able to qualify most likely upon renewal to help those in some serious need. On top of the 39% or higher GDS, in order to qualify, it has to be either at the middle or upon renewal stage of your mortgage. So taking that into effect, it can't be a mortgage that you essentially had just signed into. It has to be near the middle or the end, getting closer to renewal time. This also impacts individuals as well who are about 105% of the total mortgage being able to qualify for this type of benefit. Also, CMHC is also looking at balances that are 105% of the original loan, and especially for individuals who do have a fixed mortgage rate who are upon renewal, and looking at and able to take that into consideration and allow for this to take place with Sagent. With also taking into consent that these individuals are now in the circumstance where their debt service ratios are now going to be 39% or higher. You can definitely qualify for a higher than 15-year amortization, looking at your original income as well as with the first 12 months, your current mortgage. And if that amount is greater than the original 12 months that took place, you have to provide new employment to prove your current hardship. It's actually really interesting though, because they're allowed to go about extending your amortization without going to the insurer first, and essentially go about extending 15 years without having to go to Sagent itself, which really in the past is unlike how any of the other banks typically operate, especially with the A types, with the Scotia banks, TDs, CIBCs, RBCs. So it's a very unique, unprecedented circumstance that they're allowing to help out people in current hardship. Now the question is, what about mortgages that are not currently insured? Guess what? They can still qualify through the same guidelines. It all depends on the risk assessment that the lending institution is willing to accept. Essentially, the lenders are going to work with their underwriting team to look at the best situation based on everyone's criteria in terms of everyone's situation, and look and assess what makes the most sense, and if they're able to provide that relief to current mortgage holders. And it's very interesting that they're allowing for individuals and opening the door for a 40-year amortization, not essentially on new properties, but on properties that were purchased, and individuals are now feeling the financial hardship, allowing for that relief to help with the current circumstances that are taken with higher payments as well as the higher cost of living. Looking at all these factors is definitely going to impact your mortgage down the road with the interest rates going on, and especially with the amortization, because for those individuals who are taking this relief now, it is helping them now, but in the long term, they're going to have to pay those funds back, and they'll be paying more interest and essentially holding the mortgage much longer with their current institution, which could actually potentially end up leading to them paying a higher interest rate with the current mortgage holder instead of being able to refinance and work with another mortgage institution down the road. And from a refinancing standpoint, it's going to be very challenging because property values have decreased substantially, especially in the large market centers of Vancouver, Toronto, Montreal, all throughout Canada, and even North America as a whole, that it's going to be harder because essentially in order to refinance, you have to have at least 20% equity into the property. And a lot of individuals who purchased their property in the last year or two have actually lost property values from when they purchased it, meaning they have less equity and probably don't have too much of an opportunity to go about refinancing. Never mind looking at their own financial criteria based on income, expenses, and so on and so forth. Down the road, it looks like at some point you may be able to work alongside with CMHC as well as Sagent for refinance capabilities, as you saw in the early 2000s. Now that is a possibility, but we will say that as long as you have a mortgage, now essentially whether it's variable, fixed, variable with fixed payments, there is some sort of relief that your lending institution can provide based on the circumstances that we currently said to prove that you're going through hardship, allowing the institutions to increase your amortization and making your GDS drop as well as dropping your payments. But in the long term, essentially it is going to lead to higher payments, higher interest over the long haul. Now, in a nutshell, you're going to have the ability to have the relief, but it's also going to creep into your equity because it's going to take a lot longer because you're increasing the amortization period, which means it's going to take you longer to have equity and have access to it. And also too, with prices dropping because of the high interest rates that have gone and taken place, it's going to be a lot longer and it's going to be harder to be able to have equity that you can refinance. But that's currently the circumstance that we're in. At some point, I do believe that we're going to see interest rates continue to stop at some point. Now, it could be the next few years, it could be 5 years, it could be 6 years, it could be 2 years, it could be next year. We don't really know at this point in time, where eventually interest rates will kind of potentially stop and could potentially go back down or potentially could go back up. Historically, what we saw within the 2 to 3% range has actually been the lowest that we actually seen. It was more hovering around 6 to 8% historically, but who knows? Anything can happen in the future depending on many economical factors. And honestly, we highly recommend that you reach out to a mortgage specialist, reach out to your lender, and be able to look at the different options, look at Sagent's options, look at the lender's able to do before talking about what we just spoke about in this video, and just essentially look at what makes sense based on your current situation and what's going to help you and your family for the long haul that makes sense. So don't just look at it today, look at it over the long haul, because what you do today can definitely impact you 5, 10, 15, 20 years and put you in a position that you can easily regret down the road. And thanks so much for watching, guys. I hope this video is super helpful, insightful, and gives you all the information that you personally needed to know about this mortgage bailout situation that's going on and the possibility to be helped out through Sagent. I'm Josh Savars, investor, realtor with eXp Realty Broker. It'd be so amazing if you can help us out. Hit the like button, hit the subscribe button, hit the notification bell to get updates on our newly uploaded content. And if you're looking to invest in real estate at a low price point, great cash flow, great equity standpoint, let's book a call. Let's partner together and help you grow your portfolio in ways you won't see here in Ontario. And also too, if you're looking to sell, buy, or have any friends or family members who are looking to do so internationally, not necessarily just Toronto and GTA, we have access to a massive network of real estate agents that can help you, your family, and we will be able to help because our real estate brokerage, of course, is digital and has the ability to help people internationally because we essentially have our own metaverse that we can help people from different states, provinces, countries. There is no border that is too big for our brokerage at this point in time to help our clients in different parts. So if you have anyone who needs any help in that circumstance, please reach out. Thank you so much again for watching our video. Take care.